The need for qualified settlement funds, QSFs, emerged in the 1980s. Insurance companies grew anxious that settlements made with an entity or directly to an individual would not qualify for immediate tax deductions. They lobbied Congress for the ability to deduct payments in the year of the settlement instead of when the payments were distributed. Congress acted in 1986 by enacting Section 468B of the Internal Revenue Code. A qualified settlement fund, and 468B, allows the defendant to receive an immediate tax deduction. With a QSF, a defendant can transfer settlement funds, receive a current year tax deduction, and obtain a release of claims. Also, plaintiffs may finalize the settlement terms without tax implications until the funds from the qualified settlement fund are disbursed. This framework allows the QSF administrator to determine the allocation among the claimants. While Section 468B initially focused on designated settlement funds, it was later amended by Congress to grant the Treasury powers to develop regulations. Qualified settlement fund accounts were thus born by regulation. It is worth noting that, in the past, some insurance companies and large self-insured businesses have opposed the implementation of QSFs. However, numerous recent favorable court cases stipulating using QSFs have made such objections moot. To qualify, a QSF must be established pursuant to an order from or approval by a governmental authority. Additionally, it must settle one or more disputed or undisputed claims asserting at least one liability. All claims must stem from an event or a related series of events. Unrelated events are not allowed. Finally, the QSF must be created as a trust under state laws, or the assets are segregated from those of the transfer and related parties. QSFs have provided many tax and other financial advantages for the defendant and the plaintiff for decades. To access more educational content on QSFs and various other trust products, visit easternpointtrust.com.